we believe in being proactive versus reactive.
Sure.
So some ideas is in the form of the proactive tax planning ideas. You should always keep focused when reviewing your overall, what's the true return to you after tax, and how are some ways and things that you need to think about. Well, here in 2022, the tax brackets have changed. They're adjusted a little bit each year. And just some things to think about. During this year, the standard deduction for a married filing jointly couple is going to be $25,100. That's for signing. That's a dollar-for-dollar deduction taken as soon as you start your return.
Yeah, and you have to itemize quite a bit of things to get above that.
Yeah.
So that's
Used to be a very small percentage of our population itemized their deductions. And now, because here a few years ago with the passage of the Trump tax cuts, the standard deductions were increased, and now
hardly
even
anybody
a
does.
smaller percentage, much smaller percentage of the small percentage do it. So if you're a single filer, it's in essence half that, you're the standard deduction. And we always like to, especially for pre-retirees and retirees, if you're having to take money out of your holdings, that and you're taking into account long-term capital gains or taxable distributions.
Right.
It's one thing we sit around and talk about each week, I'm sure, with different client situations, is making sure that if there's a way that we don't flow into the next tax bracket, that's we don't want to pay undue tax if possible.
Right. And a lot of retirees have a fairly low income because Social Security doesn't count 100% toward your income.
That's exactly right.
And, if you don't have a high standard of living, which, hopefully we've all saved and able to have the living we want. But if you don't, and you take a big distribution from a qualified retirement account, it could throw you in from going from 12 to a 22% or 22 to 32% tax bracket. That amount of money that's in that bracket you're basically taking a part of your gain and giving it away.
Correct.
Correct.
Timing also comes into play, as you mentioned. And, and nothing more so as if you look at the capital gains tax rates.
Sure.
And in 2022, those rates are a little known fact is if you're not in the 15% tax bracket, if your income is for a married individual is $83,350 or less, then you're actually going to pay zero
on your capital gain. Yeah. Now that's capital gain. That's not income.
Exactly. So once you flow out of that and up as a married filing jointly above that, then you're paying 15%.
Right. So knowing which account to take out of is an important part of the process, right?
And making sure that these are long-term rates, not short-term. So these are for holdings outside of retirement accounts that's been held for more than 12 months, not less than 12 months, because that would be short-term and a much higher rate.
Right.
So anyway, as we go forward, if you make more money, your income's higher, and it gets above the $500,000 range, slightly above, then you're paying 20%.
Yeah. I hope they don't ever oversimplify the tax code, because us and a lot of CPAs and accountants won't have as much to do.
Yeah, if there's ever a flat tax, we'll just sit here quiet and just be, the podcast will be silence. That's right. So anyway, we some other ways that we talk about with clients is ways to defer tax or possibly reduce their income, but also save for the future. Is these, as you'll see, and I'll reference verbally, some of the 2022 retirement contribution plan limits. Individuals can save if you're under the age of 50. You're able to save $20,500 towards a 401k or a 403b, 457 account. If you're in a simple IRA, you're able to put in $14,000 a year. Anybody putting into Roth IRAs or traditional IRAs can put in $6,000 this year. Mm-hmm. And then for all those that I just mentioned, there's always a catch-up contribution that's able to be applied for those above the age of 50. And
that comes right out. That deducts some dollar for dollar from what your earned income is that year when you put that in there.
So if you're
in most cases,
we really need to look at which one's most beneficial, a Roth IRA or a traditional IRA. But also, one of the things that we look at the end of the year for individuals getting bonuses. A lot of times you can do some tax planning
Right.
because if it comes at the end of the year, you're able to, instead of getting taxed on all that bonus, you're able to possibly, if the 401k allows or your retirement plan at work allows it, you can defer more
Right.
and save on some taxes there.
Right. And all the goal of all this is to have as much money for your, for you and your family as possible. And I'm amazed at the amount of people that we talk to that have company retirement plans and don't participate in them.
No.
And not only the tax benefit, but they're usually getting some sort of match where they could, if you put in $1, they'll match $1 up to a certain percentage of your income. And people just, neglect it or unaware to do that.
Turning away free money. Just
Yeah,
turning away free
yeah.
money. So another thing that we bring up a number is just your annual gift exclusions. It's up to $16,000 this year that you can give to a person that's exempt of the gift tax, and that's per person. If you're wanting to give away to your, a kid and
Right.
you want to give a big amount, you'd want to give, and they're married, give it to them and their spouse. You could give $32,000, $16,000
Right.
to each, and you could also do that contributing to a working child IRA or gifting to a 529 plan would apply.
Right.
In that
And
regard.
that's a great tool to have if you have a large estate or amount of money and you're trying to plan for the future. That's something you need to have a discussion with someone that's knowledgeable about it on the best way to do that.
So all these items are ways that we feel that the discussion centers around being proactive and not reactive.